for a long time, we've been looking at earnings season in past earnings cycles saying, hey, this is good news. We're going to finally get some outlook from the companies, see what they're seeing right now, too. Earnings season and the outlooks, is that good news or bad news? What do you think we're going to hear from companies this time around?
Well, I think what you'll hear is the fact that earnings growth is slowing down, but that is because we had a really special year in 2018 because of tax cuts. Overall, economic growth is lower and probably slows down some more. So I think pitching your market expectation off of earnings alone, I think, is probably not how things are going to pan out.
Yeah, I think, Joe, probably this time around, the outlook is what Wall Street's so concerned about. What should we hear in terms of the outlook from companies right now?
Right. I think the outlooks are going to be key because, so far management guidance ahead of earnings season has still been holding up pretty well. I mean, there's been areas where you've seen slowing guidance, particularly around the CapEx outlook, given the uncertainty. So I think that's one area we're watching. But earnings guidance overall has held up well. So I think what companies are saying around China, what companies are saying around tariffs, so far so good up until this quarter. It's mostly been an impact on areas like industrials, but the outlooks are really going to be what companies.
I mean, I guess my thought would be as CEO confidence has come down, CEOs are probably not going to feel really comfortable sticking their necks out and saying, here's what we see. My guess would be that what you'll hear will be very limited in terms of the scope of the outlook if they're not blaming problems on China or a slowing economy or something else.
Right. It's interesting. When we looked in December, which is typically a lighter month for instances of management guidance, the instances of guidance were lower than usual. So we saw only 25 instances of S&P 500 guidance in December, and that was a record low. You've seen a secular downshift in companies issuing guidance over time, but that could suggest there was a bit more uncertainty leading into this earnings season than usual.
Krishna, what do you think the biggest risk to the market is right now?
Well, the biggest risk in the market, I think, still remains trade. So if you kind of take a step back, coming out of 2018 into 2019, it was going to be about slowing economy and better policy on two fronts, on rates and trade. And I think on rates front, the Fed has effectively backed off. So I think that's a good thing. Even if they tighten one or two times more, I think they will put enough color around it to not spook the market. Trade is an open issue, but I think we will find a resolution because of the data flow that we are seeing today, which is Chinese economy is slowing down meaningfully, U.S. economy is slowing down meaningfully. That gives the politicians significant incentive to come to a conclusion. We have to find that conclusion relatively quickly. If it doesn't come about, then that's probably the biggest risk.
Okay, if you think we do find a resolution to trade and you think that's the biggest risk, and we've already seen the Fed kind of moved out of the way, is that a reason for being sharply positive here?
Oh, absolutely. Absolutely. I think valuations are better. There's no recession imminent. I think 5 more years is what we are talking about. Valuations are meaningfully better. So, and sentiment improves with the trade talk. So I think if we can find that resolution and this the federal government opens up again, I think we'll be all home free.
Are you waiting and seeing to see that there are resolutions to these things? Or are you telling people to buy right now?
We are telling people to buy right now because we expect these resolutions. And the reason for that is basically economy slowing down and putting pressure on the politicians.
Okay, that's a cyclical argument. I'm with you. I see getting a resolution to these things, but if the economy is slowing down and that's why the politicians are pressured to get to that point, does that mean you should be concerned? Are we going to be looking at an economic recession?
Well, so economy is slowing down, but in the U.S., it's still going to grow north of 2%, which is probably above trend. In China, things have slowed down, but they have already started easing. So yes, things will slow down, but not slow down to a catastrophic level.
Okay. Jill, you are a little more concerned about things and a little more reluctant to put money to work right now. Am I correct?
Well, we're still positive on U.S. equities. So we have a 2,900 target on the S&P 500 for year end. We definitely think it's going to be a bumpier ride, and you want to pick your spots within equities this year because we are later in the cycle. We are in a period where high quality stocks we think should outperform, but it's an environment where you want to own large caps over small caps, for example. So we are more cautious on small caps, which have seen obviously a good bounce recently. But we think there's a lot of reasons there that even though valuations are much more supportive, we think smaller stocks look a lot riskier due to they've actually been seeing weaker fundamental trends, so lower lower earnings revisions and growth, weaker guidance. So that's been one area where guidance has been a bit weaker. And then leverage is a big concern there as well, where they have more floating rate debt, shorter average debt maturities, record leverage ratios relative to large caps.
That's interesting because they escape some of the pressures. Like a lot of times, small caps aren't selling to China, so you don't worry about some of the things that you worry with an Apple or a GM or somebody like that.
Right. I think for some small caps that's true, whereas for others, a lot of these companies are suppliers to the big multinationals, or they don't have as much pricing power, aren't as easily able to shift supply chain. So I think they're not as completely insulated from anything around trade as one might expect from a purely domestic company.
Fair to say that you don't see a recession in the works in 2019 or maybe even early 2020?
Right. We're not penciling in a recession for this year. The market obviously does typically lead the economy, so we do see risk that the market could peak out sometime in 2019, but we're still obviously forecasting upside to equities. As we look at signals like the yield curve, typically inverts at the end before the market peaks and before a recession. One thing we haven't seen is equity euphoria. So you haven't seen the typical, everyone all into stocks that you typically see at the end of
That's the argument we get again and again from people who say, we're not done yet. Krishna, do you have to get to that euphoria before you really see a major pullback?
Well, I think that certainly would be an indicator, but I think this time around, if it is going to end, it is probably going to end because of bad policy rather than anything else. That is, the overall growth trend on a global basis is significantly lower than it has been in the past, and therefore, if somebody, whether it's the Fed, whether it's President Trump, makes a mistake in terms of implementing policies or forcing policies, I think that's how things will end. Otherwise, it's going to go on for a long period of time because inflation is not there, and that doesn't, that sort of provides the cushion that we need for the markets to continue to do well.